In this market update, see why the deficit is only 1/3 of the equation. Hi, Jim Gore from THOR Wealth Management. Well, over the last several months, we've heard a lot about the trade deficit because Trump is saying that's why he's putting on the tariffs. However, that is only 1/3 of the equation. And if you look at this triangle here, or sometimes they use a three-legged stool, they come into equilibrium. So you look at trade, which we're hearing about the trade deficit, capital surplus or deficit, are people putting more money into the United States, and then that will impact your currency. And that is what has happened over the last several years. And if you look at this chart here, we all know we have a trade deficit, but actually we've had a trade deficit since 1990 and on a monthly basis. But you can notice here, it really picked up after 2009. The monthly trade deficit has exploded. And more recently, you see it fell off the cliff, but that's because companies were going ahead and loading up on goods before the tariffs kicked in. So that's an anomaly, but more importantly, you can see that the movement has been higher since 2009. So we have a trade deficit. That's 1/3 of the equation, okay? The second is capital. Are you having more capital come into the United States than the deficit? And actually, you can see from this chart, this is foreigners owning U.S. debt or treasuries. And since 2009, it's gone up threefold, from a little bit under $3 trillion to almost $9 trillion that foreigners own of our debt. So and this does not include other money that foreigners have put into the United States. I've heard that, in the at the end of the year, it's estimated that foreigners have $8 to $9 trillion of U.S. equities as well. So foreigners have put more money into the United States. Capital has been higher than the monthly deficit. So what does that do? Well, that impacts the U.S. dollar. So this is like at 2009. Since we had trade deficits over that time period, but the dollar has gone up through the end of last year. It was up 45% since 2009. Why is that? That's because capital has been greater than the trade deficit. That means the dollar has gone up. So this goes the other way. And if you go back and look at our last market update, we talked about why we like foreign securities and why we think the dollar is going to have a tough time here. Because if you do not have capital coming into the United States that's above the trade deficit, we will have the dollar falling. And that's really what has happened in the last month and a half. Is keep in mind, it's at 1/3, 1/3, 1/3. The capital account and your trade account, if they equal out, you'll have no change in your currency. If trade deficit is higher than your capital account, you will see the currency fall. And that's what we're expecting, not only what we're seeing right now recently, but probably over the next several years. I do want to throw in one other chart here that I thought was interesting because it's really showing something that is different. We're watching the delinquency rates out there, and they are going up. But this is actually one that's looking at the smaller banks. So this is all banks that are not in the top 100 large banks here in the United States. And this is looking at their credit card delinquency. And what's interesting is it's at all-time highs, higher than what it was back in 2002 recession or 2008 and 2009 recession. So this is saying that, yes, the consumer is suffering. It is going up in the larger banks, but not as much as it is in the smaller banks. But this is a sign that we're possibly going into recession. As always, if you have any questions or concerns about your portfolio, do give us a call or reach out to us at THORWealthManagement.com. Take care and talk to you in a couple weeks. Subscribe to the THOR channel today.